Hey, we're back with another video again. This time we're going to be explaining bonds, right? So a bond is a fixed interest financial asset issued by governments, companies, banks, and other large entities, right? So basically you're buying these bonds from an institution, and in exchange they give you a fixed periodic amount paid to you, and it's going to have a specified end date when the bond matures, right? The maturity date. So this is when your bond is cashed in and you get the principal returned to you, but you're going to be getting those payments the whole time too, right? So it's a secure form of income. So what this is good for is it's a fixed income that tends to be less volatile than equities, which is great for when you get close to like retirement age and you can't afford the large swings of the equity market of stocks. So it's pretty good to sometimes allocate a small percentage of your portfolio to lower your risk amount, to put a little bit in bonds, put a small percent. This will mitigate a lot of your risk, or at least some of your risk. If you have, it's kind of like, oh, well, just in case, if securities are hurting or whatever. Like recently with the correction we had, it was good to have bonds. If you did, you made good money. So there's different kinds of bonds. There's Treasury Bonds, which are really low risk, but they tend to be a low interest as well. So there's not a lot of reward to that, right? You can do the Treasury Bonds. There's 10-year Treasury Bonds, whatever. There's corporate bonds, which are a medium level risk. They tend to pay an okay return, so you're gonna make a little more percent, 3%, 4%. But they're still companies. They can default. They tend to be usually good companies, or companies that are backed by assets or good credit history. So there's a low default rate with a lot of these corporate bonds. Then there's stuff like junk bonds, which is another form of like a high risk corporate bond. So these tend to pay a good interest rate, but they have a higher default rate. You're loaning money to businesses with not so good of credit. They have unclear repayment plans, so essentially they're a lot more risky than with the regular corporate bonds. These are the not your grade A bonds. These are your lower class bonds. Your companies that really they have had issues with money in the past. Their debt to income sheets don't look so good. They have borrowed a lot of money already. There's companies like that, but you get a higher interest rate, so if you're willing to take on that more risk, you're able to make a little more money for your money. So another thing I want to talk about, and I did this in another video already, and this is like private bonds. Think worthy bonds, think Fundrise, person-to-person lending or peer-to-peer lending, those kind of things. Those are your private bonds. Now those in a sense are risky in a different way, because even if the people you're lending to have a pretty good credit history or whatever, they're still going to default. Now you're basing your money off of, in the case of worthy bonds, you're basing it off of, is this company going to be able to collect this money from these collateralized loans, right? Are they going to get that money back from you? Are they going to be able to pay me? So you're taking on that risk that it's one company you're trusting your money with. So that is a little bit more risky, and it's the same thing with Fundrise. With Fundrise though, money is illiquid, so you can't really pull it whenever you want. You're locked in for a certain time period. And personally, I don't really believe in illiquid investments. I think you should be able to get your money whenever you want. You should be able to pull it out. You should be able to, okay, I need access to that. I have access to it. Or if the market's tanking, or it's going to tank, you should be able to pull it out before that happens. It shouldn't be just stuck, So I'm not a huge fan of Fundrise and things like that, because your money's just trapped. So I personally do REITs. I do stuff like that where I get a similar return to something like Fundrise, but I'm able to pull that money out and sell it on the open market if I need to. So I don't usually mess around. I haven't really yet messed around with like peer-to-peer lending. I find that if someone has to go to a peer-to-peer lending thing to get their money or to get a loan, I feel like that's way more risky than somebody who has good credit, is already just going to go to a bank. They're going to get a good loan. So that's, to me, is extremely risky to loan your money peer-to-peer. And I think that those people that are coming to you for those loans, now you can correct me if I'm wrong, if I'm not understanding correctly, but I believe those are very risky loans. They're not really backed by anything. These are people that are, they already are bad with money. They've already racked up credit card debt. They're coming to you to bail them out on that, so they can hopefully not rack up more credit card debt, and hopefully they'll pay you. But to me, that's extremely risky. So this is pretty much the different types of bonds. I personally don't do a lot of bonds. As being 25 years old, I usually mess a lot with equities. I have a lot of my money in stocks. So I don't usually tend to mess with them, but as I get older, I will start to allocate more, like 1% and 2% and 3% of my portfolio towards bonds as I age. But at this current time, if you're young, I wouldn't really suggest doing too much bonds, maybe 1% or 2%. if you're risk averse. But if you're getting up there in age, I would definitely say, you know, play around with a little more bonds. I still think equities are better in the long run. But I mean, that's pretty much all I have to say about bonds. If you guys have any questions, if you guys like the video, don't forget to like it. If you guys haven't subscribed already, think about subscribing and join the community. And I'll talk to you next time.